Welcome to This Explainer. Look, today we're skipping right past the basic, everyday financial advice to completely dismantle the exact blueprint used by the top 1%. You've probably heard the same standard advice your whole life, right? Get a good degree, secure that steady promotion, skip the extra lattes, and just save your pennies for retirement. But here's the thing, that advice is designed for a system that relies on mass participation, not individual financial sovereignty. The source material we're breaking down today reveals how institutional wealth managers look at the world through an entirely different lens. We're going to unpack some advanced capital architecture and see exactly how the ultra-wealthy structure their empires to become completely 100% self-sustaining. To really grasp why this shift in perspective is absolutely crucial, we have to look at the mathematical reality of the modern economy. Right now, the middle class is playing a mathematically rigged game of addition. You know the feeling. You try to add a little bit to your savings account each month. Maybe you put $500 away and you feel like, okay, I'm moving forward. But meanwhile, the broader economy is performing massive subtraction on your life savings. Between 7% global inflation, subtle fiscal policies, and hidden tax leaks, you're quietly losing $600 in purchasing power while celebrating that $500 deposit. It's literally the financial equivalent of running up a down escalator. You don't just need a bigger savings account. You need an entirely different system, so your hard work isn't constantly being erased by economic gravity. So the solution to this is what's known as the sovereign capital framework. And the definition we're working from today describes it as a closed-loop asset ecosystem. But what does that actually mean in the real world? Well, think of it like a perfectly sealed, self-sustaining terrarium. The moisture, or in our case, the capital, never evaporates out into the open air of the IRS or inflation. Instead, it continuously cycles right back into the soil to grow more assets. The whole goal here is to legally bypass systemic market risks and multiply your buying power exponentially, even when the broader economy is completely tanking in a recession. It's all about operating like your own independent financial nation, rather than just being a temporary employee of the economy. Okay, let's look at our roadmap for this explainer. We're going to cover three specific pillars: the liquidity arbitrage matrix, synthetic asset renting, and finally, the phantom tax shield. Let's dive right into Pillar 1, the Liquidity Arbitrage Matrix, which is all about velocity over accumulation. To build this first pillar, we really have to break this ancient inherited lie that the absolute safest thing you can do is just lock your money in a vault and leave it there like some kind of monument. In macroeconomics, static money is dying money. We can see this crystal clear through the mathematical reality of how capital scales, known as capital velocity. The formula basically says your velocity is determined by your total annualized earnings divided by your average idle liquid assets. Let's ground this with a real-world example, okay? If you earn $100,000 a year, but you let $50,000 of that just sit in a dead, traditional checking account for emergencies, your capital velocity plummets. Literally every single day it just sits there. Its purchasing power rots away. The ultra-wealthy understand that minimizing the time money spends sitting completely still is step one to sovereignty. So, instead of hoarding cash under the mattress just to feel a false sense of security, sovereign investors maximize their velocity through two very specific pipelines. First up, short-term, high-yield vectors. They park their working capital in high-yield corporate credit instruments or ultra-short treasury notes that are compounding at, say, 5 to 7%. The money is still completely liquid and accessible, but it's constantly generating yield while it waits. Second is the Opportunity Strike Fund. Now, they do keep a portion of hyperliquid cash, but absolutely not out of fear. This is attack money, deployed specifically to strike when economic corrections happen. When the broader market bleeds and over-leveraged sellers start panicking, the elite use this strike fund to instantly scoop up cash-generating assets at incredibly steep discounts. Your capital should always be working or locked and loaded, ready to deploy. Moving on to Pillar 2, synthetic asset renting, or decoupling your labor from your capital. This second pillar builds directly on the concept of asymmetric leverage. Look, when most people hear passive income, they automatically think of taking out a 30-year loan for physical real estate, tying yourself to one static location, dealing with broken pipes at 2 a.m., property taxes, and just heavy overhead. And while that's valid, it's highly inefficient and binds your capital to physical friction. True sovereign architects are building or acquiring synthetic assets. We're talking intellectual property, proprietary software, automated media networks, digital equity. These are assets that can be licensed, duplicated, or distributed globally to millions of people simultaneously with near zero marginal cost. They capture massive global yield without any of the physical bottlenecks of the traditional legacy economy. Never allow your personal physical labor to be the bottleneck of your income. I want you to seriously think about that for a second. If you wanted to scale your current product, service, or asset to 1 million users tomorrow morning, could you actually do it without drastically increasing your own personal working hours? If your answer is no, then the harsh truth is you don't actually own a scalable sovereign asset. You just own a really high-level, highly demanding job. Okay, that brings us to pillar 3, the phantom tax leak shield. Time to plug the boat. So you can have absolutely incredible cash flow from those first two pillars, maximizing your velocity and building amazing synthetic assets. But if you have structural cracks in your financial architecture, you're effectively pouring water into a bucket full of holes. And the biggest, most glaring hole in that bucket is the 40% structural tax trap. When you earn income under your legal personal name as a W-2 employee or a direct freelancer, you're operating in the absolute highest taxed format on planet Earth. You take on all the stress, perform all the hard labor, and the state just swoops in and takes up to 40% of your gross energy right off the top. Boom, gone. You're then forced to try and build your future wealth using only the weak leftover scrap capital. Honestly, it's a mathematically exhausting way to try and build an empire. How do we fix the leaky bucket? Well, the elite change the sequence of how money flows through their lives. In a traditional setup, you work to earn income, you get taxed immediately on every single dollar, and then you try your best to survive and invest with whatever happens to be left over. But in the sovereign framework, you flip that. You route all cash flows through an asset holding entity first. The gross revenue is legally utilized to reinvest in the entity's own expansion, marketing, and further asset acquisition entirely before taxes are ever applied. You pay taxes only on the remaining net profit after your empire has already grown. You are effectively using incredibly powerful pre-tax capital to compound your wealth, completely changing the speed at which you can scale up. This entire defensive perimeter is anchored by a foundational institutional rule: own nothing but control everything. The ultra-wealthy rarely, if ever, hold valuable assets in their own personal legal names. Instead, they utilize robust corporate holding structures and layered trusts. It's like a giant puzzle. For example, a trust might own a holding company, and that holding company owns a series of LLCs, and those LLCs hold the actual intellectual property and synthetic assets. The individual controls the entire machinery that generates the wealth, directing the cash flows and enjoying all the leverage, but they own nothing personally. This drastically reduces personal liability and completely seals off those structural tax leaks. Let's pull this all together and summarize the blueprint we've unpacked in this explainer. Building generational freedom is fundamentally a mathematical system. It is not a test of pure physical exhaustion. Step 1, you absolutely must maximize your capital velocity so your money is always compounding and never decaying. Step 2, you need to transition into building or scaling synthetic assets that completely decouple your time from your revenue. And step 3, you have to protect those hard-earned inflows by shifting from a highly taxed individual earner to a corporate sovereign architect, utilizing a phantom tax shield to plug those leaks. So I'm going to leave you with this question to ponder. Which of these 3 pillars have you neglected the most up until today? Take a moment to honestly evaluate your own financial structure. The legacy system desperately wants you to keep playing the game of addition, trading your limited, exhausting hours for temporary paper currency that slowly loses its value. But the choice to step out of that matrix, to build an unshakable asset machine, and to finally claim your financial sovereignty, that is entirely in your hands. Think about it and take the first real step toward building your own architecture today. Thanks for hanging out with me for this explainer, and keep learning.